Today's the day. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. And before we start, just a quick reminder that tonight at 8 p.m. Sydney time, you can join me for my live show. And this week's guest will be Chris Bates, and he's a mortgage broker in Sydney. So he'll be talking about the property market and the impact of the RBA decision, which will come out at 2:30 this afternoon. Join us. Should be an interesting show, and you can ask a question live. Australia's central bank is all but certain to raise interest rates today to slow accelerating inflation, piling pressure on consumers who are among the most indebted in the world. In fact, all but one of 26 economists that were surveyed by Bloomberg expects the RBA to raise its cash rate target by half a percentage point today to 1.35%. That's a level not seen since May 2019. One, Market Economics, is forecasting a larger 75 basis point move. The RBA, in fact, is behind its peers, having held rates near historic lows until increases in May and June that lifted its benchmark by a total of 75 basis points to 0.85%. A 50 basis point hike today would mark the first time Australia has hiked by that amount at consecutive meetings. And while the country is facing similar inflationary pressures to other economies driven by surging prices of gasoline, electricity and food, its consumers are among the most indebted globally, with the household debt-to-income ratio at a record 187%. Central banks in the US, the UK, Canada and New Zealand have all moved much faster to curb inflation, while also alarming investors who fear that aggressive hikes may trigger a recession. The RBA is raising interest rates at a slower pace than its counterparts, and the RBA has to tread carefully not to crush the consumer if it wants to avoid a serious growth downturn, said a senior economist at AMP Capital Markets. She estimates the cash rate will peak at 2.6%, compared with hawkish bets in the money markets for a 3.2% in December and a high of 3.7% next year. In fact, Australia's $2.1 trillion economy does appear to be holding up quite well after the first two rate hikes. Most economists have downgraded growth forecasts, though, with Nomura Holdings so far alone in projecting a recession. Yet, there are some signs of consumer fatigue, including weekly card spending data from Australia's major banks, which points to a slowdown in June after months of stellar growth. Private consumer surveys also indicate a pullback in spending. Governor Philip Lowe has said rates are likely to rise by up to 50 basis points on Tuesday, while pushing back on suggestions his board could make an outsized 75 basis point move. If Lowe opts to wrong-foot economists and markets, he could, of course, raise the benchmark by 40 basis points. That would take the cash rate to 1.25% and return it to a more traditional quarter percentage point multiple. Chris Reid, Australian economist for Morgan Stanley, does expect a 50 basis point increase in July and August, followed by a quarter point hike through to November, taking the cash rate to 2.6%. Broader slowing of jobs and inflation won't be felt until late this year, keeping the second half 22 rate hikes on track, even as risks grow for 2023, he said. But with the Reserve Bank set to raise the interest rate another half percentage point today, Swiss-based global investment bank UBS has forecast the collapse of Australian home loans by up to 40% in the coming months. And in addition, the UBS chief economist has calculated a slump in house prices by at least 10% and in home sales by more than 20%, consistent with the lagged impact of prior RBA tightening cycles. It's plausible the weakness in loans is greater, given the speed and magnitude of RBA hikes is set to be bigger this time, he said, quoted in the AFR. The latest Melbourne Institute monthly inflation gauge also pointed to a very strong headline CPI result in the June quarter, according to the Financial Review, which economists have predicted would play into the central bank's interest rate hiking cycle and eventually pull the median rate to 2.35% by December. And of course, fuel prices remain close to an all-time high that they recorded in late March, with the average family spending $295.54 a month to fill up the car, very significantly higher than previously. And I'll make the point that my latest mortgage stress data does show a significant rise this month. I'm going to go through that in more detail in a separate post, but I would make the point that now 45% of households are registering cash flow issues even before the July rate hike. And this is, of course, concerning because it's hitting a lot of households. And whilst everybody's talking about the buffers that are out there, I must say again, the buffers are not equally spread. There's around 30% of households with significant buffers and doing absolutely fine. There's another 1/3 of households down at the other end of the spectrum who are living paycheck to paycheck and are really struggling. And there are some in the middle who have some buffers and some savings and some access to credit cards, but they're using up those buffers very quickly and therefore are drifting towards those who will be living hand to mouth. We are at a very delicate point in the cycle here, but I have to say that my perspective is the Reserve Bank is going to go 50 basis points today, and that is going to underscore their commitment to trying to tackle inflation, once again aping other central banks around the world. The problem, of course, is as rates go higher, this is going to put a significant dampening effect on the broader economy. And so the question is, will the Reserve Bank go on hiking until it breaks something, or will it just go on hiking nevertheless? Well, we'll have to wait and see. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.